So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. Today we're going to be mixing technicals with fundamentals. Note that in front of your screens right now you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame unless otherwise stated. Now, despite the US dollar actually dropping over the past few days, you can see it right here, that was on Thursday. It corrected upwards during Friday and seems to be regaining its sideways momentum just below the 104.25 resistance line right now. Interestingly enough, the US employment report for May on Friday failed to actually provide substantial support, or if you prefer, lasting support. So let's drill out to the minute chart and see what the market reaction was at the time of the release. It was interesting. Here you go. Further back. It was this candlestick here. You can see how it jumped, went all the way up to 30 pips or so, then corrected lower and regained. So practically there was some initial market reaction, but it wasn't that wide. And that was understandable given that the US employment report for May tended to send out some mixed signals. It was characteristic that the NFP figure jumped up way above market expectations, while on the flip side, also the unemployment rate rose. And that tended to more or less cause USD bulls to hesitate, in my opinion. Overall, there was an initial market reaction which was more or less, I wouldn't say sideways, but still not as impressive as expected. But later on, you can see that was around 1 hour later. We saw that the US dollar started to gain and jumped even higher during today's opening, remaining rather stable, gained and stabilized once again just below the 104.25, back to the forward chart, readjusting it. So for the time being, we tend to maintain a bias for the sideways motion to continue. There are some slight bullish tendencies though, and those are obvious mostly from, let me readjust the labels a little bit, reposition them. So some slight bullish tendencies seem to be present, and they are more evident in the RSI indicator, which has risen above the reading of 50 substantially and is currently at 58.1, sorry. So that more or less tends to imply a residue of a bullish sentiment left in the market. It's going to be interesting to see whether exactly these bullish tendencies will be also present at today's US opening. Should that be the case, and for bullish outlook, we would require the index to rise above the 104.25 and start aiming for the 105.45. Possible reasons for a bullish outlook on a fundamental reason is that after the agreement for the rise of the US debt ceiling practically being verified from the Senate late on Thursday's American session, given also that we had the employment report for May not containing any substantial elements which would practically more or less force the Fed to shift its stance. Because, okay, on the one hand, the US employment market remains tight, but definitely the rise of the unemployment rate to 3.7% may have rung some bells in the Fed. I would be noting another issue which tended to pass a little bit under the radar, And that was not the NFP figure as such, but the elements comprising it. And we saw, okay, there were some gains in government jobs, yeah. There were some gains also in private payrolls, yeah. But the manufacturing sector was in the negatives, even slightly. It was at minus 2K. It's not material as an amount as such, but it would be evident of a slowdown, or if you prefer, a contraction of economic activity in the wider US manufacturing sector. And that definitely tends to keep our worries on a macroeconomic level for the US outlook. So we have mentioned the possibility of a bullish scenario. Should the index remain rather stable in sideways manner, we may see it maintaining a course just below the R1, 104.25, or even rotate around, revolve around the R1. For a bearish outlook, we would require the index to drop and reach, if not even breach, actually breach clearly the 103.05 and start slowly but steadily aiming for the 101.55. I wouldn't expect it to reach the S2, no, but I would require it to break the S1, at least for a bearish outlook. Once again, a bullish outlook is possible. In this case, I would expect it to break the R1 and start aiming, if not even reach the R2. A sideways motion could be just below or around the 104.25 level. While for a bearish outlook, we would require the index's price action to drop, break this 103.05, and we're talking about a clear break here. Now let's have a look at Euro USD. We're adjusting the chart. This is the daily chart, back to the 4-hour chart. That should be more evident. Now Euro USD seems to be nearing or reflecting the movement of the US dollar index, only in reverse. There seems some stabilization. Definitely the downward trend line guiding the pair has been broken. So practically we tend to highlight this possibility as a sideways motion. Let me clear this. There you go. So we tend to maintain a bias or a sideways motion between the 1.0735 and the 1.0655. Please note that the RSI indicator is dropping below the reading of 50, and it's currently at 42.7. There may be a residue of a bearish sentiment. So should the US dollar strengthen, we may see some bearish tendencies for Euro USD. For a clear-cut bearish outlook, we would require the pair to drop, break the S1 1.0655, and start aiming for the 1.0545. That would also allow us to draw a downward trend line, exactly showing the limitations of a downward movement. On the flip side, should the bulls take over, we may see the price action of Euro USD rising, breaking the 1.0735 and start aiming for the 1.0805. Let's have a look at GBP USD cable. In a similar fashion, only far more clear. Let me readjust the labels as well, once again. The pair is currently testing the S1 1.2395 right here. You can see it right now. There seems to be a more clear-cut downward trend line guiding the pair. Let's draw it. It's very intense. And I think it's indicative of the RSI indicator, which has broken below the reading of 50 and without hesitation seems to be aiming for lower grounds. It's currently at 41. So the bears have not given a convincing case just yet. but that seems to be the case. Definitely, the upward trend line guiding it seems to have been broken. And on the contrary, a downward trend line has started to form. The price action is currently testing the S1 1.2395. We may see the pair clearly breaking this one and start aiming for the S2 1.2190. On the other hand, should the pair stabilize, which is also quite possible, we may see the price action revolving around or just below 1.2395. On the other hand, a bullish outlook does not seem to be probable right now, but it's still a possibility and it should be covered. In that case, we may see the RSI indicator rising, breaking above the reading of 50 and start aiming for higher grounds. While the price action is expected to rise, break the downward trend line we have just drawn and was initiated on Friday, start aiming, if not even breaching the 1.2465 resistance line, aiming for higher grounds. Moving now to USD/JPY, which was in sideways motion and actually still is. Okay, there was an upward movement, but the overall sideways motion between the 140.75 and the 138.30 seems to remain intact. There was a slight downward trend line that seems to have been broken. So for the time being, we tend to maintain a bias for a sideways motion to continue, possibly between the 140.75 and the 139.65. For a bullish outlook, we would require the pair to rise, break the R1 140.75 and aim, if not actually breach, the 142.30. While for a bearish outlook, we would require the pair to drop, break the 139.65 and start aiming for the 138.30. Mind you that there are two interesting elements about the market sentiment, and the first would be that we have an RSI indicator which is fast approaching the reading of 70. It's currently now at 63, while the price action has almost reached, it actually even tested at some point, the upper Bollinger Band, which may slow down a little bit the bulls. Moving now to USD/CHF. Let's reposition the labels a little bit. Now, there are a couple of elements here. The first would be definitely cancel. The upward trend line has been shifted to the right. There you go. You can see these touches 1, 2, 3, 4, 5. But, and it's a big but, for a bullish outlook, I would require a higher peak than this one. So the price action has to clearly break the 0.9115 resistance line and start aiming for the 0.9220 resistance level. On the other hand, we may see that the pair seems to be finding some difficulty in actually breaking the R1. It was interesting how it hit the ceiling during today's European session at that level, even if that's temporary. Nevertheless, should the price action remain below the R1, or if you prefer just below the R1, then we would be tempted to switch our bullish outlook in favor of a sideways motion. For a bearish outlook, we would require the pair to drop, break the upward trend line we have just shifted, but I would also require the pair to break below the S1 0.9020 and start aiming for 0.8935. And that could be explained in the sense that A possible break of the upward trend line would be a definite sign that the upward movement has been interrupted. A break also below the S1 0.9020 and the price action to start aiming for the S2 0.8935, that would be a signal, in my opinion, that the bearish outlook has begun, even a short one. Let's have a look at the Aussie. So the Aussie has broken above the 0.6580 and is correcting lower, aiming for that level once again. For the time being, that has to be changed into a support line. And let's go hunting for a new ultimate resistance level. Seems good. In red. 0.6920. Make the necessary corrections also on the labels and everywhere. It's a little bit wide, but symmetry is not my main concern right now. So we are repositioning the labels, and let's correct the content as well, starting with the S3, which is now being placed at 0.6385, the S2 at 0.6490, the S1 at 0.6580, the R1 at 0.6690, and the R2 at 0.68, with the R3 being now at 0.6920. Blocking everything in. So let's discuss direction. A, there was a clear upward movement of the pair, which was interrupted, and actually it intensified at some point. And I think that would be more obvious in the 1 hour chart. Here you go. Now we can see in the 1 hour chart how the pair stabilized and actually corrected lower, breaking both upward trend lines. So for the time being, we tend to switch our bias, so our bullish outlook, in favor of a sideways bias. And should that be expressed by the market, we may see the price action remaining above the S1 0.6580. Mind you that the RSI indicator is at 57.1, but it's still dropping. That's another indication that the bullish outlook or the bullish sentiment is fading away. So I would expect initially the price action to stabilize just above or around the S1 0.6580. Should the bears clearly take over, or for bearish outlook if you prefer, I would require the pair to drop, break the S1 0.6580 and start aiming for the S2 0.6490. On the flip side, should the bulls take over, we may see the price action bouncing on the S1 and aiming, if not even reaching, the S2 0.6690. That would allow us practically to draw a new upward trend line, showing us the limitations of the upward movement. Now, on the fundamental side, I would be highlighting tomorrow's RBA interest rate decision for the pair. But before that, let's discuss a little bit about the US releases during today's American session. And I would be highlighting practically the factory orders growth rate. That's for month-on-month for April. I think should it slow down or contract even, we may see the US dollar losing some ground. On the flip side, a bit later, we're also getting from the US the ISM non-manufacturing PMI figure. It's for May. It's expected to improve. It's still above the reading of 50. So that still shows us some expansion and contraction, say, for example, with the manufacturing sector of the US. So that's a positive, and that could provide some support for the USD. Now, there is, I wouldn't call it a myth, but still a perception that the US economy is mainly a manufacturing one, industrialized one. I would be placing, I wouldn't say even equal, but maybe even equal weight between the manufacturing and non-manufacturing sector of the US economy. It's quite well balanced over the past few years. So I wouldn't be passing the ISM non-manufacturing PMI figure that easily, at least on a macroeconomic level. I'm not saying what's going to be happening with market volatility, but it's still important in my opinion. Now, RBA's interest rate decision, which is expected to affect the Aussie side of the pair, is due out during tomorrow's Asian session. Also, mind you that we're getting the current account balance. It's, I think, for Q1. But most probably it would be overshadowed by RBA's interest rate decision. The bank is between hiking and not hiking. On the one hand, we had some comments by RBA Governor Lowe, where he stated that practically the monetary policy settings are restrictive already and are working, which more or less tend to imply that, okay, we already have a restrictive monetary policy and it is working, so why would we need to hike rates once again? On the flip side, though, around half an hour after he made that statement, we had the release of Australia's CPI rates for April, and they accelerated. Now, given that RBA is considered to be quite data dependent, and given that the latest data regarding inflation are not exactly positive, they're rising. So that may induce the bank to proceed with another rate hike. Now, should the bank remain on hold given the acceleration of the CPI rate for April, I think I would expect also the bank to issue, or at least, Governor Lowe to issue a statement accompanying the decision which may be more tilting towards the hawkish side. In case we see, though, the bank remaining on hold, I would expect primarily the Aussie to weaken, so AUD USD would be dropping. But that drop could be restrained should Governor Lowe actually deliver such a hawkish statement. On the other hand, should the bank actually proceed with another, or if you prefer, with 25 basis points rate hike, I would expect the Aussie to gain. And I would expect to gain substantially here. Market sentiment, or market expectations to be more exact, seem to be divided right now. We're talking about AUD/OIS implying a probability of around 57% for the bank to remain on hold, with the rest 43% actually implying that the rate hike is also possible. But AUD/OIS during today's European session seem to be, because we're watching them, seem to be a little bit off the charts. So I don't know if we could trust them that much. But overall, yes, they would still provide us with a clear indication about what the market reaction could be. Nevertheless, let's not forget that there's still almost 18 hours until the interest rate decision, so lots and lots can change within those hours. Let's have a look at USD CAD. Okay, USD CAD definitely has broken the S1, 1.3545 and has stabilized on Friday and during today's Asian and European session. But the key takeaway here is that the S1 turns now into a resistance line, and we have to go hunting for a new ultimate support line. Let's unlock the chart, go further back. These are some nice truths here, but they are far too narrow to the S2, so I'm going further back. I think this one's it. There you are. And we're talking about mid-November last year. In green, that would be the 1.3225 support line. It's interesting because it's the level at which we saw the strong downward movement. 1.34. Yeah. And we saw the strong downward movement of USD CAD being holded right here. So it's a key level. And you can see that it was aimed for, tested, retested, and then took an upward movement. So in my opinion, that's valid. Let's readjust the chart and correct, first of all, reposition the labels. The R3 from the R2 is pretty wide off, but once again, I'm not interested so much in the symmetry of the resistance and the support lines. Also note how the S1 from the R1 is pretty wide. Also note that it almost touched it, practically verifying it. Let's move it slightly upwards. $34.5. Okay, let's correct the labels. Starting with the R3, which is now being placed at 1.3805. We are 1 at 1.3665. We are 1 at 1.3545. The S1 at 1.3405. We've changed that a little bit. Let's not forget. The S2 at 1.3315. And the S3 at 1.3225. Locking everything in. Let's see if the downward motion is still being maintained. And it seems to be not. It's a very, very interesting movement. On the one hand, we have the RSI indicator, which at some point dropped below the reading of 30. Now it's slightly above it, at 32 almost. And that tends to imply that there's still a residue of bearish sentiment left in the market for the US dollar against the Canadian dollar. On the other hand, though, we see that there has been a stabilization of the pair just above the 1.3405, as it seems to have hit the ceiling at that level. Hit the floor at that level. So for the time being, and given the breaking of the downward trend line, we tend to switch our bearish outlook in favor of a sideways motion just above the S1. Yet, on the other hand, given that there's still a bearish sentiment left in the market, we may see the bears regaining control. In that case, we may see the pair dropping, breaking the S1 1.3405 and start aiming for the 1.3315. For the time being, it seems that a bullish outlook is rather improbable, but given the stabilization of the pair, I wouldn't exclude it totally as a possibility. Okay, it has low chances, but it's still a possibility which could take the markets by surprise. In that case, I would expect it to rise, break the median of the Bollinger Bands, break above it, break also the moving averages of 50 and 100, and reach the R1 1.3545. Once again, though, such a scenario for the time being is improbable, but still a possibility. Okay, let's have a look at the Kiwi. Actually, you know what? Let's skip the Kiwi. Let's have a look at gold. Gold, which has been dropping. We are talking about the 4-hour chart. Yep, has broken the 1955. Let me correct this into a resistance line. Let's go hunting. Unlocking the chart. Next level could be here. That's true. And that would be in green. The 1885. Yep. Readjusting the chart. Let's readjust the labels as well. And as we're readjusting the labels, it's interesting to note how the RSI indicator dropped and is currently aiming aiming for the reading of 30, implying that there seems to be a bearish sentiment building up for the pair. Starting with the R3 being placed at 2002, the R2 at 1975, the R1 at 1955, the S1 at 1935, the S2 at 1910, and the S3 at 1885. So overall, we tend to maintain a bearish outlook, and in such a scenario, we may see gold's price breaking below the S1 1935 and start aiming for the S2 1910. On the flip side, should the precious metals price stabilize, we may see the price action remaining between the 1955 and the 1935 in a sideways motion like this. While a bullish outlook, okay, despite seemingly being improbable, right now we may see the price action of gold rising, breaking the R1 1955 and start aiming for the 1975. I would be noting here the negative correlation between the US dollar and gold's price. And I think that would be one of the main key factors, if you prefer, on a fundamental basis for the precious metals direction. Now, should the US dollar strengthen further during the American session today, we may see gold's price dropping below the 1935 as one support line and start aiming for the 1910. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, just a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Okay. So this material is just a personal opinion of the authors and the client's investments objectives, and risk tolerance have not been considered. Okay. IronFX is not responsible for any loss arising from any information contained. So redistribution of the material is strictly prohibited. Okay, I think I might have a setting that I need to change. Okay, wait. Okay, give me a moment. Setting up. Okay, let me continue. Kindly increase your volume. Yes, yes, please increase the volume. I think I'm speaking at the max as loudest as I can already. So let us begin. So I'm actually from Everest Fortune Group, and my name is Chen Yongjing, and I'm the trade analyst for the company. We are the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a special collaboration with IronFX, where we are bringing you guys the good stuff. So IronFX right now, you can actually go to ironfx.com. For those who do not know, you can go to the website. If I'm not wrong, IronFX School under webinars listed as popular. You can see let it load first. Okay, you can see okay, I'm not sure why my face is not up here yet. All right, it's okay. So you can actually see the upcoming webinars. Wait, let me find okay, over here. We have the timetable for the upcoming webinars that you guys can actually attend. So right now is this webinar is live. So feel free to check this link out. So by the way, I know some of you guys want to contact me outside of this webinar. So feel free to check out my link tree. So this is actually a quick guide about myself. You can actually check out my Instagram, my YouTube, my LinkedIn profile. Feel free to follow me. All right, let us begin. So today will be a shared webinar. It will be with myself, Yongjing, and Sarah. So at the second half of this webinar, Sarah will be taking over. Okay, let us continue. So a few topics to cover today. So we'll be covering on, let me pull this chat around. We'll be covering on basics of news trading, key news events to watch out for, how each news event affects the markets, and 3 types of news trading strategy. So today will be a very, very dry lesson. So be prepared, get your coffee. I won't be showing much technicals. Today is all about the news, all about fundamentals. It might be boring, but it will help you a lot in a basic understanding of how news events actually affect the market, how you can bank on it to, scalp or either take a long position. So coming up first, 4 main factors to consider. Firstly, it's crucial. Okay, you can see a few points here. News events to pay attention to, what news events you want to pay attention to, and the expected data. So you want to also check the price reaction from previous news release. So firstly, it's very crucial to keep track of news events. I'm reading these points. And expected data releases. Economic indicators such as GDP, let me write this down, GDP, unemployment rates, inflation, can significantly impact currency values. Therefore, keeping an eye on the economic calendar and being aware of upcoming news releases can give traders like you guys an edge in predicting the market movements. So secondly, the price reaction from previous news releases is also an essential factor to consider. Traders can analyze how the market reacted to previous data releases and use this information to make educated guesses about how the markets will respond to future releases. So doing so, what you can do is you can go to Forex Factory. Let me show it to you. You can head on to Forex Factory. I'll send the link to the chat, so it's under calendar. Feel free to check out this link. Forex Factory, head on to Forex Factory. You start to look at all the news events. For example, tonight we have the United States dollar, core retail sales month-on-month, Empire State Manufacturing Index, retail sales month-on-month. So you do not know what does it do, how does it affect the markets. So what you can do, you can read a quick summary, click on it, read how it usually affects what you can have a summary change in total value of sales at the retail level, excluding automobiles. Can read more details about it. Go back to the forecast. So I think the more important one is core retail sales. So you can go back to the previous data release, which is on September 15, 2022. Go to your chart, click on it, start to go back and see how the news event actually impacted the United States dollar. So go head on to your DXY chart. Negative 0.3% versus previous 0%. So September 15, we can take a look at it. Let me load out my layout. Okay, so we'll be going through on core retail sales month-on-month on the DXY chart. Okay, DXY. So let's go back on the daily chart. September 15. September 15, right here. So notice upon the news release, price actually caused price to continue moving up in the long run. So you can actually start to look at maybe the 4 hours or 1 hour chart, want to see what happened on September 15. So September 15 around at night, price actually shot up before heading back down. You can start to check a reaction, what it does. Hits up first, clears the previous high. So every different news release is very, very different from each other. So find out the characteristics. First, it went up, cleared the previous high, went back down, tapped into some kind of support. So you backtest it and backtest this. I'm just giving you a very, very basic example. So you start to move on. I wouldn't be showing everything. So you'll be moving on to October 14, 16, December 15, January 18. Start to look at all this data, how it affected, how price moved. Get into account. Please do not just jump right in and try to trade the news event tonight just because you did some quick back tests on core retail sales and retail sales, Empire State Manufacturing Index. So moving on back to the charts. Okay, back to the PowerPoint. So current trend, why is it very important? Okay, current trends in the markets are another crucial aspect of Forex trading. Traders can use technical analysis tools to identify trends, such as moving averages or trend lines. It's essential to know whether the market is trending upwards, downwards, or sideways, as this will influence trading decisions and risk management strategies. So last but not least, support and resistance levels is still very, very important in Forex trading. Important to consider. So these levels actually represent price points at which the market has historically shown support or resistance. traders can use this information to determine where to set stop loss. So you can use it as a gauge stop loss and where to put your take profit level. Okay, moving on next towards the news events and expected data. So we actually have a very nice clear screenshot of Forex Factory. So as Forex traders, it's very essential. Okay, before I continue, so we are actually focusing on the AUD. So right here, this specific news event is what we are focusing on. So as Forex traders, it's very essential to place close attention to the economic calendar and be aware of any upcoming news events and expected data releases. Firstly, these events can cause significant market volatility, which can lead to increased trading opportunities. For example, if a news event indicates that a country's economy is improving, traders might buy that country's currency, expecting it to strengthen. So as a result, the value of that currency might increase, creating a trading opportunity. Okay, secondly, moving on to the expected data part. News events and expected data releases can provide valuable insights into the health of an economy. So these indicators can help traders understand how a country's economy is performing and whether it is growing or contracting. Traders can use this information to make informed trading decisions, such as deciding whether to buy or sell a particular currency. So third points that we want to go through. News events and expected data release can influence central bank decisions on interest rates. So we have the Bank of England, the Reserve Bank of Australia, etc. So can influence central bank decisions on interest rates, which in turn can affect currency values. So central banks actually use interest rates to control inflation and stimulate or slow down economic growth. So if a central bank announces a change in interest rates, it can impact the currency value and create trading opportunities. So last but not least, news. So just to summarize overall what I've just talked about this entire slide. In summary, news events and expected data releases actually help traders to manage risk by providing insights into the potential impacts of specific events on currency values. So for example, if there is an expected data release that could significantly impact a currency, traders might choose to exit a trade before the release to avoid the potential volatility. So this is why I do not trade 1 hour, about 1 to 2 hours before the news release or 1 to 2 hours after the news release. So personally, I avoid that just to prevent any mishaps in my trading accounts. I do not want my trade to potentially cause slippage, potentially hit my stop loss, just because I wanted to be greedy and try to trade the news. So we are looking at the Aussie dollar, Australian dollar right here. So we had a cash rate. So they actually increased the interest rates. So previous was 1.35%, the forecast 1.85%, and the actual was also 1.85%. So what happened? Let's take a look how the news impacted the Australian dollar. So Australian dollar chart. So every time Australian dollar had a 50 BPS hike on the 7th June, price went down. 5th July, 50 BPS hike, price went down. 2nd August, BPS hike, price went down. 6th September, 50 BPS hike, price went down before going back up and continued going down. So we already know we have a data set, we have proven Data on the charts, data do not lie. So every time we have a news release like this, we can expect to possibly sell Australian dollar, AUD, USD, every time we have a cash rate news event coming up. So please screenshot this down before I continue. So I've already helped you done most of your homework, maybe for this specific news event. Please screenshot this down before we continue. Okay, moving on next. So I'm just zooming in on the 5th July. I'm zooming in on this right now, on this specific day that actually happened. So I cannot remember specifically because I actually did quite a number of research. So zooming in on the 5th July, 50 BPS hike, price went up, cleared the previous high right there before it, moved down all the way down towards the previous swing low, and it actually formed a support right there. So you already know price goes up first before heading down. So please screenshot this down before we continue. This is still related to the previous slide that I just showed you guys. Okay, next. The 2nd August 50 BPS hike. You notice that price also went up first respectively right there. On a smaller time frame, it then, after the news release, immediately went down towards the previous support level. So every time we can expect price to likely head up first before the news release, before potentially just continue heading down towards the next key support level. Okay, moving on next to the key news events to watch out for. So we actually this is quite a long slide that I have to go through. So there's a theme of economic focus on what happened in the past, how it affected the markets, all the fundamental drivers that affected. First of all, going through the global financial crisis. It happened during the 2008 to 2009. Then the economic focus was a lot on employment data and wage growth. So for those who do not know, the global financial crisis is also known as the Great Recession. So it had far-reaching consequences for economies and individuals worldwide. It was triggered by a combination of factors, including subprime mortgage lending, a housing market bubble, and excessive risk-taking by financial institutions. So the crisis actually resulted in widespread job losses and had a severe impact on the employment market. So the unemployment rate in the United States, for example, it rose from 5% in 2007 to a peak of 10% in 2009. So many companies struggled to stay afloat, and as a result, many workers lost their jobs. Additionally, the crisis had a knock-on effect on other economies, leading to job losses worldwide. The crisis also had a significant impact on wage growth. As unemployment rates rose, employers had less incentive to offer pay rises or bonuses, and some even cut wages. So in the US, wage growth slowed from 4.4% in 2006 to 1.8% in 2009. So let me draw it. 4.4% in 2006 to 1.8% in 2009. So it made it difficult for many individuals and families to make ends meet. Okay, let me write this down. Unemployment data, 5%. 2007, it moved to a peak of 10% in 2009. So the global financial crisis had a domino effect on the world's financial markets as the interconnectedness of the global financial system became evident. Financial institutions that had invested heavily in mortgage-backed securities and other high-risk assets faced significant losses, and many banks and other financial institutions went bankrupt or required government bailouts. The crisis also prompted significant government intervention. Central banks around the world cut interest rates, and governments introduced stimulus packages to try to prop up their economies. However, it actually took several years for the global economy to recover fully from the crisis, and many countries are still feeling its effects. So overall, the global financial crisis was a watershed moment in the world economy, with far-reaching consequences for individuals and economies worldwide. The crisis had a very severe impact on employment and wage growth, leading to a significant job losses and slower wage growth. So the financial markets and central banks all had to take unprecedented measures to address the crisis, and its effects are still being felt today. Next, we have the COVID pandemic. I guess we just got out of it. So now it's the post-COVID. So COVID happened 2020 to 2021. All of us went through it. The pandemic had far-reaching consequences for individuals, economies, and societies worldwide, and its effects will be felt for years to come. So one of the most significant impacts of the COVID-19 pandemic was on the gross domestic product, the GDP. So which is actually a measure of a country's economic activity. The pandemic led to a massive decline in economic activity as many businesses were forced to close or operate at reduced capacity due to lockdowns and restrictions. So the International Monetary Fund, the IMF, estimated that the global economy contracted by 3.3% in 2020, the most significant downturn since the Great Depression. So the pandemic also had a significant impact on employment. Many people actually lost their jobs due to business closures or reduced hours. The unemployment rates increased in many countries, and the number of people working part-time or on a reduced pay also rose. So as a result, many individuals and families experienced financial hardship, making it difficult for them to meet ends meet. The pandemic had very, very significant consequences for healthcare systems, with hospitals, healthcare workers overwhelmed by the sheer number of COVID-19 cases. Governments around the world had to invest heavily in healthcare infrastructure, including building new hospitals and acquiring medical equipment, such as ventilators and personal protective equipment, PPE. So moreover, the pandemic had a profound impact on global supply chains, with disruptions affecting industries such as manufacturing, agriculture, and logistics. Travel restrictions and border closures also led to a decline in global trade, affecting economies worldwide. So overall, governments and central banks around the world responded to the pandemic by implementing fiscal and monetary policies to support their economies. Many countries introduced economic stimulus packages, and central banks lowered interest rates to encourage borrowing and spending. So right now we have the 2023 recession that is coming up. So we'll be focusing on inflation data and interest rates. So this recession was triggered by several factors, including inflation, rising interest rates, and the COVID-19 pandemic. So inflation was one of the most significant factors contributing to the recession. So in many countries, inflation rates reached historic highs due to supply chain disruptions, labor shortages, and rising commodity prices. Commodity is wheat, corn, rice. So high inflation led to increased costs for businesses and consumers, causing a decline in purchasing power and economic activity. Interest rates were also a contributing factor to the recession. Central banks have raised interest rates in response to the rising inflation, which made borrowing more expensive for businesses and individuals. So higher interest rates also led to a decline in consumer and business spending, reducing economic activity. Okay. Give me a moment, let me get a cup of water. Okay, the COVID-19 pandemic also had an impact on the recession. The emergence of new COVID-19 variants and the resulting restrictions led to reduced economic activity and job losses. Many businesses, particularly in the hospitality and tourism industries, were forced to close or operate at reduced capacity, resulting in a decline in economic output. So the recession is leading to a significant increase in unemployment rates in many countries, and many individuals and families experience financial hardship. So governments are responding to the recession by introducing stimulus packages and implementing monetary policies to support their economies. Central banks around the world lowered interest rates and introduced quantitative easing measures to support the economy. Governments also introduced fiscal stimulus packages to support businesses and individuals. So these policies actually help to stimulate economic activity and support job growth. So this is just for general information about what has happened in the past 15 years or so. Okay, let me see what's next. Okay, non-farm and employment change. So this is a very, very important thing. It actually occurs on the first Friday of the month. Okay, one of the most closely watched, okay, just these 3 points, screenshot it down. It's related to the change in number of employed people during the previous month, job excluding the farming industry. So this is only for the United States only. Only US, it's not anywhere else in the world. So job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So it's also a high price volatility event. So NFP, also known as non-farm payroll, is a key indicator of the health of the US economy and is closely monitored by traders, investors, and policy makers. So NFP measures the number of new jobs created in the United States, excluding the agricultural sector. The report is released by the US Bureau of Labor Statistics on the first Friday of every month and provides insights into the strength of the US labor market. So the NFP report provides 2 pieces of information: the number of new jobs created in the previous month and the unemployment rate. The number of new jobs created is a crucial indicator of economic activity, as job growth typically leads to increased consumer spending and overall economic growth. The unemployment rates, on the other hand, provides a measure of the health of the labor markets and can influence central bank policy on interest rates. So the NFP report is considered a leading indicator of economic growth and is closely monitored by traders and investors. A better than expected NFP report typically leads to a rise in the US dollar's value, as investors anticipate increased economic growth and the possibility of higher interest rates. So a worse than expected NFP report, on the other hand, can lead to a decline in the US dollar's value. So as investors become less optimistic about economic growth and the possibility of interest rate increases. The NFP is also closely monitored by policymakers, including the Federal Reserve. The Fed uses the NFP report to determine whether to raise or lower interest rates. So with higher employment rates, it actually leads to higher interest rates. Okay, please screenshot this down before we continue. Okay, next. Moving on towards interest rate decisions. So central banks hike interest rates to increase the cost of borrowing. It slows down economic activity. These are the main important points only. Please screenshot it down. It reduces or slows down the speed of inflation, and is also a high price volatility event. So interest rates are a crucial tool that central banks use to manage inflation, economic growth, and financial stability. Interest rate decisions can have a significant impact on currency exchange rates, stock and bond markets, and individual financial planning. So interest rate decisions are made by central banks, which are tasked with maintaining price stability and supporting economic growth. Central banks can adjust interest rates up or down depending on economic conditions and their policy objectives. A rise in interest rates can reduce consumer spending, lower inflation, and support a currency's value. A cut in interest rates can stimulate borrowing and spending, support economic growth, and weaken a currency's value. So interest rates are typically announced after a meeting of the central bank's monetary policy committee. The announcement includes a statement that outlines the central bank's reasoning behind the decision and any future policy changes. The statement can provide insights into the central bank's outlook on the economy, which can influence financial market expectations and individual investment decisions. So it can have a significant impact on financial markets. A rise in interest rates can lead to a decline in the stock markets as companies' borrowing costs increase and consumers may reduce their spending. So higher interest rates can also lead to a strengthening of the domestic currency, making exports less competitive. A cut in interest rates, on the other hand, can lead to a rise in the stock markets as companies' borrowing costs decrease and consumers may increase their spending. Lower interest rates can also lead to a weakening of the domestic currency, making exports more competitive. Okay, let's move on. So the inflation data, the CPI. So the consumer price index, so it actually measures the change in price level, indicates the change in the cost of living, and the target CPI for the economy is 2 to 3%. So please note this down. This is very, very important. Please screenshot this down. So the CPI measures the average change in prices paid by consumers for a basket of goods and services over time. So it's a crucial indicator of the health of an economy and is closely monitored by policymakers, investors, and consumers. So inflation is the rate at which the prices of goods and services increase over time. A high rates of inflation can lead to a reduction in the purchasing power of money, making it more expensive to buy goods and services. On the other hand, low inflation can lead to deflation, which can harm economic growth and create disincentives for businesses to invest. So the CPI is used to measure inflation and is one of the most commonly used indices. The CPI calculates the average price of goods and services, including food, housing, housing, energy, healthcare, and transportation. Mind my writing. It's a bit hard to write using the pen. So changes in the CPI can over time provide insight into the rate of inflation. So the CPI is released on a monthly basis, closely monitored by policymakers and investors, provides insights in the state of the economy, and can influence monetary policy decisions. Okay, so high inflation leads to a rise in interest rates, which can increase the cost of borrowing and slow down economic growth. Low inflation can lead to a lower interest rate, which can make borrowing more affordable and stimulate economic growth. So inflation data also has an impact on individual consumers. A high rate of inflation can lead to increased costs for everyday goods and services, which can reduce consumers' purchasing power. Low inflation can lead to lower costs for consumers, making it more affordable to buy goods and services. Okay, let's move on. Right now, Sarah will be taking over. So yeah, let's welcome Sarah. I'll be taking my leave.
Hi everyone, my name is Sarah. Okay, so today I'm going to take at the second section of this webinar. So just now Yunjin has mentioned it. Okay, so for the Kiwi dollar, the CPI news is really important. So now let's take a look at the next slide. It's about how the give me a moment. Let's take a look at this slide is how the news is affecting our price and how the price is reacting towards the news. Okay, you can see before the news come. Sorry, where is my mouse? Okay, here. Can you see my mouse? Okay, so you can see before the news come, there is a very nice steadily ascending trend line. So the price is going to react it according to the trend line. Okay, and you can see before the news come, the price is more in a consolidation, means the price isn't moving very much. Okay, so it's more like up and down, but in a more horizontal way. But you see at the 6 p.m., the news have come out. Okay, so the news will affect the price of the market. That's why the price has shooted up. Okay, shooted until where? Shooted until the period swing high. So always take note when we are reacting towards the news, always looking for a reference point. Don't always say that, oh, the price may go up to here or the price may go up to here. Okay, you need to find a reference point, which is very important. Most likely the reference point is the period swing high or the period swing low. Depends on how you judge the news going to affect the market. Okay, next one. Okay, so you can see here are all the news. Here are all the news of the. Here are all the news of it's very important news on the 13th October. So always. Okay, so always remember the news event. You need to pay attention, and the expected data. Always pay attention on the current trend, okay? And always pay attention on support and resistance lines. So their price is going to reaction after from the previous news release, okay? So you need to take it as a reference. Okay, so here you can see there is a news coming up. I think it's at before the price is consolidation. So you can see the price didn't move a lot. After the news release, the price has shooted up and now retreats back. So how each news event affects the market? So for short-term effect, okay, so there are some news will affect it in a more shorter term. So for example, employment change, retail sales, and purchasing manager index. So later at 9:30 p.m., there are retail sales for USD. So maybe later we can pay attention to it and we see how the news is going to affect the market price. So employee change is a very key indicator of economic health and have short-term effect on our trading. A strong employment change report can indicate a growing economy and increase customer confidence, leading to a stronger currency. In another scenario, okay, a weaker employee change report can indicate a weaker economy, leading to a weaker currency. So most likely the employment change is correlated to the currency. So if employment change is good, okay, so the currency is going up. If otherwise, it will go down. So how about for retail sales? Retail sales are another economy indicator, indicate that short-term impact on the trading. So retail sales measure the total amount of goods and services sold by retailer. And a strong retail sales report can indicate increased customer confidence and spending. This can lead a stronger currency as the investor become more optimistic about the economy. A weaker retail sales report, on the other hand, can lead to a weaker currency as the investor become less optimistic about the currency. So this one same as employment change, okay? Retail sales good, currency go up. Retail sales bad, currency go down. So lastly, the PMI. Okay, so PMI is a survey of purchasing manager in manufacturing sector that measure the level of business activity. The PMI can have a short-term effect on forex trading. It provide the insight into the strength of the manufacturing sector and the overall economy. A high PMI indicated increased manufacturer activity and growing economy, leading to a stronger currency. So in alternate scenario, a low PMI will indicate a weaker economy, leading to a weaker currency. So all three of these are very correlated to the whether the strong or weak is the currency. So the better the number is, the better the currency. The weaker the bad the number is, the weaker the currency is. So bear in mind, so this three factor is only going to affect the currency in a short term, which means after the most likely after the news has been released, within like a few hours, or like within a short term, the price will be changed according to the news, but it's unlikely to going to affect the currency in long term. So now let's take a look at what will affect the currency in a medium to long term. What are the factors? So first one, very straightforward, is GDP. Another one, secondly, is the CIP. And lastly, the interest rate decision. So let's take a look at GDP, okay? GDP is a measure of country economic output and is considered one of the most important economic factor. GDP measures the total value of goods and services provided within a country border and provided insight into overall health of the economy. A high GDP can indicate a growing economy, which means a stronger currency. A low GDP indicates a weaker GDP and lead to a weaker currency. So imagine the news has released like United States, the GDP has went up, which means the price of the currency will go up. So secondly, let's talking about inflation data. Inflation data as measured by Customer Price Index, CPI. So it's another key economic indicator that can impact forex trading over medium to long term. A high rate of inflation can reduce the purchasing power of the currency, leading to a weaker currency. In other hand, low inflation can lead to stronger currency, which indicates a stable and growing economy. So lastly, our interest rate decision. Interest rate decision are also important indicator for our trading. So central bank use interest rate to manage inflation and support economic growth. A rise in interest rate can lead to a stronger currency, as the investor may be attracted to a high interest rate. Most they want to deposit in that interest rate, or because it's high interest rate, I can deposit over and to gain more interest. So in alternate scenario, a low interest rate means less demand of the money, which means the currency may be dropped. So this three factor or this three related news about this three factor, it's going to affect our currency in a more medium to long term effect. So imagine like this kind of news has been released, okay? Maybe the price may not move like a lot, but in the future or in a more mid to long term, the price is going to react to these factors. Now let's take a look at news trading strategy. Means how are we going to enter in a trade by the news or like according to the news? So there are three different kind of trading strategy. Firstly, entering before the trade release. So most likely we are looking at 1 hour or 15-minute chart. So what meaning by entering before the release means we are predict on the numbers. Imagine like later the retail the US retail news going to release. Okay, so let's just make a prediction whether the news is good or not than compared to the previous one. Okay, so if you are considering, okay, I have confidence in this, okay, the news is going to be good, means better than before. So this you may enter in the trade in a long position, which means I think, okay, USD will go up. So the goal is to catch the maximum move following the news release. Because you are entering the trade, most likely you are putting a buy or sell limit before the news release. So the strategy can be very dangerous, as the trader can take advantage of significant price movement. However, there is a risk of being backed off, as the market can react unpredictable to the news release, which means maybe the news may be good, okay, but the market did not respond in after the news come. So maybe the news good, but the price still dropping down. So maybe it will hit your stop loss. Then finally, the market has reacted to the news. There may be a chance in this kind of scenario. So how about our second strategy? Our second strategy is using pending order. This involves placing an order ahead of news release. Okay, so it's more likely using a 1 hour chart. The strategy has less emotional involvement. Okay, so as the traders set their orders and wait to the market to fill them. However, there is a risk of price spillage, as the market can move significantly after the news release, causing the order to be filled at a different price than expected. So our third strategy is to reacting to the news release. So means after the news release, we are reacting, we entering the trade according to the news. Most likely we are using 15-minute or 1-minute chart. So this involves the trading you used it on 15-minute and 1-minute chart. Trader wait for the news to release or to come out. Then they react based on the price movement. This strategy can be beneficial as the trader can react to what they are seeing in the market. However, there is a risk of being influenced by price movement and making irrational trading decisions. So each strategy has its own set of good advantage and disadvantage. So when we are entering the trade, think carefully to see which one is best fit your trading strategy. And also always remember, manage your risk. Trader must be prepared to accept the loss and have a solid risk management strategy in place before you enter in any trade. Okay, so that's all of today's webinar. Is there any more questions? So by the way, later at 9:30 p.m., there is a very important news on USD. So maybe you guys can pay attention on it. How would you feel the USD going to react? Okay, so if no more questions, I may just end today's webinar. Thank you, Adrika Das. Thank you, Iram Atadi. Thank you, Mogizi Likope. And thank you, Steve Code. Okay, forgive me if I pronounce your name wrongly, but really thank you for you guys attending this webinar. Okay, that's all of today's webinar. Thank you. Bye.